Hi folks, this is your host Mandeep. It's been a while since I've done a video, and what we will do today in this session is take a look at how to select, options, strike price as well as the expiration month if you want to trade options, right? I mean, the reason a lot of people fail with options is because there is there's no methodology behind it. They're shooting from their hips. And if you really want to trade options, then you have to trade options like how pros do it, right? There's clearly a method to the madness. I oftentimes am asked this question even in my Discord room. Well, why did you choose a particular strike price in a particular month? And those aren't selected just randomly. I just use a method, and I'm going to share that method exactly with you guys, so you can incorporate that into your trading methodology if you think it's actually useful. Right. So options, as you all know, get tricky, right? So the reason it's tricky is, first of all, you need to have your bias correct, right? So if you're long options, the stock has to move in the right direction. And second, more importantly, it has to move in that direction in the time frame that you chose, right? So for example, if you have an option that is out 30 days, and your bias may actually be correct, but the stock doesn't move enough, you're going to lose the entire premium on it. So that's why a lot of people, or majority of the people, end up losing money on options. But how do the pros do it? Majority of them actually end up doing vertical spreads, right? By doing a vertical spread, you're buying a certain strike price, and then you're selling a higher strike price. So let's say the stock is, you pick 60 and 65 strike price. So you buy the 60 calls, you sell the 65 calls, and this way you are reducing the amount of risk that you're taking, but at the same time you're also capping your max profit. So let's say on a $5 wide, strike prices, you pay $1 in premium. Your maximum profit is going to be the difference between the two strike prices minus the premium that you paid. So in this case, let's say you paid $1, your maximum profit will be 5, which is the 65 minus 60 minus the $1 premium that you received, right? And this holds true whether you're selling calls or you're buying calls, right? So what we'll do today is we'll look at a technique that I've actually learned and use it consistently in how I select the stock prices and trade them, right? So so if many of you or some of you may actually be using a service that gives you these unusual option prices, and that helps you sort of follow what the smart money is doing, right? So if smart money is going after a particular stock and they do it repeatedly, then that's one viable way of doing it. But let's say you don't have the time, to do that, but you have Thinkorswim, and you say, all right, what can I look at Thinkorswim that will enable me to select certain, stocks that have some unusual activity happening. So this is your normal scan, right? So one of the things that Thinkorswim provides standard with their scan is called the top 10 sizzling stocks. So let's take a look at that and run the scan on it. Now, hopefully, it gives you some reasonable number of stocks, and does in this case. And one of the things you look at is this thing called the call sizzle, put sizzle, and the overall sizzle index, right? So what essentially it means is when the number is 5, that the calls traded or outpaced the it traded at 5 times of its normal volume, right? And the average that they take is last 5 days, right? So this traded 5 times more than the normal volume. So this is KBR, which is obviously KBR builds homes, and then you have ALKS, which is a biotechnology company. We'll just focus on these two stocks in the interest of time. So let's take a look at ALKS. So one of the things you notice is obviously the put sizzle volume was very low. So clearly there was interest on the call side, right? So it traded about traded 4.9 or 5 times the normal volume. Now let's go into the trade, and let's take a look at option time and sales, right? So when we look at option time and sales, you see for May 42 there were like 4,500 calls. That was the biggest volume that was bought. So you have is 4,500 showing up twice. So let's just go back into the May option, and what we see is something interesting. There's absolutely no volume on any of the other strike prices except that you see volume on the 35 and you see volume on the 42, right? So the interesting thing is there's already some open interest of 5,479 on the 35 and a similar number on the 40. So it's very likely, again, nobody can say for sure, that they could also be there in the spread for sure, right? The 35-42 call spread. And we will only know on Monday whether, if this number goes close to zero, that means all these positions were closed. So they actually close this spread. However, if this number doubles, right, if it goes to roughly 10 and 10, then you know that these guys actually bought the calls, right? That's something we'll only know on Monday. But since this is just for educational purposes, let's assume that they were looking at these strike prices. And for you, it becomes pretty obvious that, if I want to trade this and I want to trade them long, then these are the strike areas that I would actually focus on, right? So that's an interesting piece of information that you have. Now let's go to the chart, right? This is a chart where we have ALKS on the daily chart, and we're going to add a couple of things. So the first thing we'll add is we go to the gear and go to the time axis, and we'll add the expiration Friday. So this way you can see the expiration Friday, and I'm going to create an expansion area. So 35, I'm going to put 35 in this and apply this. So what you see here is now that you've got this empty area on the right hand side, right? So next we'll do is we'll add a study which is called probability of expiring cone, and we add that and we look at what the parameters are. So it's a 100-day. It's looking at 100-day, and the probability range is 68. So essentially, it's looking at one standard deviation, right? If you were to add and change it to 2 standard deviation, you would just change this number to 95. But let's just stick with 1 standard deviation for now, and we'll apply this. So what do we see? I'm going to get rid of this. So what do we see here is this is the expiration date, right? So let's go back and look at the actual trade. They were looking at May, and they were looking at this spread, assuming they were looking at the long spread, right? So back on the chart, you can see this is your expiration Friday. This is 5/17. This is when the May options expire, and one standard deviation says that the stock has a probability of going down to 31.54 or very close to 42, which is exactly the strike price that they have chosen. So in other words, when they do this, they have a method to their madness, right? Because these pros aren't trading, just definitely not shooting from their hips. They basically have a methodology behind it. Now, if you also go back and look at the trade, and you'll see for May, the actual probability is plus or minus $4. So it has a volatility of implied volatility of 39, and it can move plus or minus $4. So go back and look at the chart, and the stock is trading at 36.50. So that puts it at about 41-ish area, right? Now, if you go look at it, this kind of like jives fairly closely with what the expected move is on ALKS up or down, right? Now let's add one other thing, and one of the things we can look at is the Fibonacci retracements, right? So if you go ahead and click on the Fibonacci retracements, you already have the high and the low plotted, right? This is the high and the low of the year, and so you take this and you would draw this line all the way down here. Now, what you will notice is that I'm actually missing a bunch of numbers, right? So this is 50%, but where's 38%? There's 76%, and etc. So I actually focus on 51, 50 and 61.8. But in your case, in this example, let's look at all the retracements. So let's get rid of this. But when you plot it, you will see all those lines. So let's remove this drawing, and we'll have a study called Fib retracement, and I'm going to add that. So apply that study and add it, and now you see all these numbers, right? So this is 100, this is 0, this is the the low and the high range, and now you have the Fib retracement drawn. What is one other interesting thing that you notice? We're looking at this area, so the Fib is projecting the stock to move to about this level, which is 42, and these guys 42, a little bit above 42, 42.78. This probability of cone is projecting 41.65. So let's assume it's somewhere in the middle, right? So that's their strike price of 42, right? So that now gives you a target, right? Instead of just shooting in the dark, now you have a well-defined range, right? So this is the maximum it can move to um, till the May expiration, right? So this maybe we can draw this using an ellipse and see. So this is your target area roughly, right? So now in this case, assuming that they're actually still trading long, so the whole idea is that they're trading long the 35 option, right? And they're selling the 42 option, which totally makes sense if you look at this probability of cone, you look at the intersection of the fib retracement with the probability of cone, and you have your target, right? So in this case, it would make zero sense if you were to pick an option that's expiring at 45 or 46, because that's not what the market is projecting, right? So just using this simple methodology, at least you have a target of what to trade on. Now, there was one other example of KBR homes, and let's take a look at that as well, real quick. So let's look at KBR. And in this case, the fib retracements are automatically drawn. And let's just remove this drawing for a bit and look at the trade. So in this case, KBR, we'll again look at option time and sales. Uh, and let's just get rid of this for now. So one of the biggest options, 3,000 calls were bought for 18th of April, right? So let's go back and look at the option chain and focus on April. And you see something interesting again, no volume at all on any of these other options, right? And there's the only strike price where they're focusing on is the $20 strike price. So they're basically going long the 20 strike price. And again, so the interest rate, the open interest is 450. So they can be selling these, right? So these are all new positions. So now look at the chart again. And what do we see, right? So this is your intersection, right, of the probability of cone and your fib retracements here. So this price is 20. So this is the target price that they have, right? So that's at least now is giving you sort of a consistent and you know um, scientific way of actually looking at what strike prices and what monthly expirations you want to use. So let's say you want to go out to May. So you could be, you could look at this as a maximum. So you could be buying something like, 20, 2150 call spread if one exists, right? So this way, you have a very, very clear idea as to why you would choose a particular strike price. So hopefully, this helps. Now let's go back and look at ALKS. And one of the things we'll do is we'll add something called the strategy that we use, which is called the ultimate trading signal. And let's look at what that is projecting in this particular case, right? So we're looking at ALKS, and let's see if it gives us any kind of a signal of whether the bias is on the long side or on the short side, right? So again, there's a couple different ways of looking at this. You can go into a little bit more aggressive mode here. So you select the aggressive mode here, apply this, apply, hit OK, and we'll come and see. And there's a buy on this side. There's a buy that just got triggered. So in this case, if I were to trade, I would consider the strike prices of 32, and let's go back and take a look at it, which exactly the strike price for May was, which was 35, right? So this would be a reasonable bet, right? So you're here, you've already got a buy signal. Again, I'm not making any kind of recommendations to buy or sell this stock, because the first thing I'll do is look at it on Monday and see what happens to that open interest, right? But at least using this very simple methodology, hopefully it gives you a fairly good idea of how to trade options. Now what we'll do is we'll take a look at some other charts just for interest, and we'll take a look at, let's just look at a template that I like here, which is something that I've created, and that's something that I use with the team that we trade with on Discord using the ultimate trading sort of strategy. So let's just look at MSB test. And what we'll do is go through a couple of these stocks, and let's look at these on the 30-minute time frame, right? So as you can see, let's just switch this to a slightly different, instead of aggressive, we'll go into something new that I'm working on, which is called swing mode, and apply this and look at this on a 30-minute chart, and you can see here's when the buy actually got triggered, and this triggers based on this pivot, right? This is the 20-day pivot, and you've got a little bit of profit. You've got another $1.98 on this. You've got Pizoon. This is something that I actually ended up trading. You got a buy signal, and you got a profit of $1.08. Let's look at EDU. It's got a profit of $2. So almost everything in this list, and this is the list that I provide when people actually get the signal from me, that enables you to select stocks, right? So instead of worrying about 5,000 stocks, you're not clearly focused on like 10 or 15 different stocks, and almost like all of them will have, will either show you winners or no trades, and of course there's some losses because there's no system that's perfect. But the couple stocks that we focused on was one was Bizoon. We also traded the CMG the other day. We actually took a April's 700 spread on this one, and as you can see, it produced some profitable trades as well, and this trade is currently in as well. So there's another trade on DRI, Darden Restaurant, which opened here at 119.81 and actually closed at 121. So that was profitable. And I mean, we can, just pick anything, but there was another stock that had some good profit, which was At Home as well, that triggered on the day, right? So this triggered on Friday at 93.25 and gave you a profit of $10.02. So I have a link in my in this video where you can actually learn a little bit more about the ultimate trading strategy and how that works. And hopefully you have a little bit better idea of how to trade options going into the future. Thank you.